Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are looking at Algorhythm Holdings.
And if you find our talks useful, please consider subscribing, liking, and commenting underneath. It really helps us out.
So today's company, it's a fascinating one, a true turnaround story.
You know, usually when a company pivots, the gentle turn, a coffee shop starts selling pastries, that kind of thing. But today, we are looking at a pivot so violent, so completely out of left field, that if you saw it in a movie stuff, you'd tell the writer to tone it down.
It really is one for the books. I mean, we are talking about a company that looked at its business model selling karaoke machines and said, you know what?
Let's stop.
Let's stop the singing and start fixing the global supply chain with artificial intelligence.
It sounds absurd on the surface. We're talking about Algorhythm Holdings. And to be clear to everyone listening, this isn't just some quirky anecdote. This company has been at the center of a massive market storm just this week.
A huge storm.
We're seeing billions in value just vanish. We're seeing washout signals on the charts. And we're seeing a technology that claims it can solve a trillion-dollar problem.
Right.
So let's dive in. What is the actual mechanism here? Because you don't just wake up one day and swap microphones for 18-wheelers.
No, you absolutely don't. And that's what makes this so interesting from a capital allocation perspective. This wasn't a drift. This was a surgical amputation.
Okay.
Algorhythm was the holding company for the singing machine, you know, the karaoke brand we've all seen. It was their bread and butter.
Right.
But the board looked at the balance sheet, looked at the margins, and just made a really hard call. They divested the entire singing machine business to the Stingray Group.
Which is a classic clearing the decks maneuver. You dump the capital-intensive, low-margin hardware business to free up cash.
Exactly. They wanted to become a pure-play technology entity. They needed to stop worrying about inventory and, shipping plastic microphones.
So they could focus entirely on their new thing, which is solving this empty mile problem.
Yeah. That's it, the empty mile problem.
Let's spend a minute on this because it sounds like a sad country song.
Yeah.
But economically, it is a disaster. I was looking at the data you pulled, and the inefficiency it's just staggering.
It is.
1 in 3 truck miles driven in the U.S. is empty.
It's shockingly high, isn't it? And when you scale that up globally, the numbers, they become almost hard to comprehend. We're talking about 400 billion miles annually.
400 billion.
Driven by trucks hauling absolutely nothing.
That is just lighting money on fire.
It is. It translates to roughly $1 trillion in wasted shipping expenses every single year.
$1 trillion.
And that's not even touching the carbon footprint, the wear and tear on roads, or the wasted driver hours in a labor market that is already so tight.
And this is where the industry fragmentation comes in, right? Because you have thousands of shippers, thousands of carriers, and none of them are talking to each other efficiently.
It's a total coordination failure. Precisely. And that is the gap that Algorhythm is trying to close with their platform, SemiCab.
Okay, so SemiCab is the solution.
This is the core of their new identity. It's not just a load board where you post a job and hope someone takes it. It's an AI and machine learning engine designed to predict capacity.
Predictive. That's the key word there, because if you're just reacting, you're already too late.
Right. The AI looks at the entire network and orchestrates what they call fully loaded round trips. So instead of a truck going from A to B and then driving empty to C,
the system finds a load at B that needs to go to C, or close to it.
Exactly. It stitches together a continuous loop. The value proposition is simple. Shippers pay less because they aren't subsidizing that empty return trip, and carriers earn more because their trucks are full.
It's the holy grail of logistics. High utilization, low waste. But, and here is the massive but, if this solution is so elegant, why did the market absolutely panic this week?
Yeah.
I'm looking at the charts for February 17th and 18th, and panic might be an understatement. We saw reports of a $17.4 billion market value drop, triggered by this tech.
It was a bloodbath. And we need to dissect this carefully because there are really two ways to read a chart like that. One is that the tech failed catastrophically. The other
is that the market sentiment just broke.
The market sentiment broke, and looking at the volume, this just screams sentiment break to me.
It does. It really does.
On the 17th and 18th, Algorhythm hit every unusual volume list out there. When you see that kind of volume spike alongside a vertical price drop, you are watching a capitulation event.
A washout.
A total washout. The weak hands, retail investors who got scared, algorithm bots triggered by the volatility, they all sold at once. It's a transfer of ownership.
Which usually implies that these so-called smart money or institutional accumulators are on the other side of that trade, catching the falling knives because they see a disconnect.
That is the contrarian view, yes.
Right.
The sentiment right now is technically neutral to bearish. The shock is still fresh. People are bruised. But if you look a little deeper, there's a contrarian bullish signal flashing. And management is actively trying to steady the ship, which suggests they believe the market has just fundamentally misunderstood the event.
It feels like a classic overreaction to complexity. The market sees a headline with AI and losses and just hits the eject button. But let's look under the hood at the actual business.
Right.
Because the stock price is not a business model. How are they actually making money now that they aren't selling karaoke machines?
They've structured the business into two distinct arms, and it's a clever geographical split. You have the India operations and you have the U.S. operations, and they function very differently.
India is the managed services arm, correct?
Correct. In India, they are getting their hands dirty. They contract directly with Fortune 500 FMCG companies.
Fast-moving consumer goods. So we're talking toothpaste, snacks, all that high-volume stuff where margins are razor thin.
Yeah, exactly. And in that sector, logistics is the whole ballgame. If you can shave just 2% off shipping costs for a massive snack food conglomerate, that's millions of dollars in pure profit for them.
Sure.
So Algorhythm takes over specific lanes of their freight network. They start with a pilot, prove the savings, and then expand into these multi-million-dollar regional contracts.
So India is the proof of concept. It's the laboratory where they prove the AI actually works in a chaotic real-world environment.
And it generates cash flow. Then you flip to the U.S. side, which is the Apex platform. This is a SaaS model, software as a service.
Okay.
Here, they aren't necessarily managing the trucks themselves. They are licensing the brain, the optimization engine to third-party logistics providers or 3PLs and other big enterprise shippers.
Which is the scalable high-margin revenue that Wall Street usually drools over. Build the software once, sell it 1,000 times.
That's the theory. And the synergy is that the India operations are feeding all this data into the algorithm, making it smarter, which in turn makes the U.S. product more valuable.
But this brings up the inevitable competitive question. Logistics is a crowded room. You have giants like C.H. Robinson, J.B. Hunt. I mean, guys who've been moving freight since before the internet existed.
Right.
Why can't C.H. Robinson just hire 100 engineers, build their own AI, and crush algorithm like a bug?
This is the moat question, and it's the single most important thing for an investor to understand here. The advantage Algorhythm has is that they are AI native. They started with the algorithm.
Okay.
The legacy giants are fighting what you'd call organizational inertia.
It's the difference between building a Tesla from scratch and trying to retrofit a 1990 Ford Taurus to run on batteries.
That is a perfect analogy. The legacy providers have systems built on code from 20 years ago. They have thousands of employees whose workflows are built around manual brokerage people on phones, calling people.
It's a different culture.
To pivot that ship takes years. Algorhythm is a speedboat. But beyond the tech stack, there are the network effects.
Walk us through that. Because network effects gets thrown around a lot in tech. How does it apply to a truck in Ohio?
Think about it like a dating app. If you're the only person on the app, it's useless, right?
Right.
If everyone is on the app, the matches get better. In logistics, every new shipper that joins the SemiCab network adds data about their routes. Every new carrier adds data about their capacity. The more data points you have,
The more efficient the round trips become. The algorithm just gets smarter with volume.
exponentially smarter. It creates a defensive barrier. If a competitor tries to launch a copycat tomorrow, they might have the code, but they don't have the liquidity of data. They can't offer the same efficiency because they can't see the whole board yet.
That makes sense. It's a flywheel. But let's play the role of the skeptical auditor for a moment.
Let's do it.
We've painted a rosy picture of tech and potential, but we have to address the bear case. What are the red flags? Because you don't drop $17 billion in value without some skeletons in the closet.
Absolutely. And there are significant risks. First and foremost, you need to know that Algorhythm is a smaller reporting company.
Okay.
And when you dig into their SEC filings, there is a phrase that should always make you pause. Material weaknesses in internal control over financial reporting.
That is corporate speak for our accounting department might be messy.
It doesn't mean there's fraud, not necessarily, but it means the rigorous checks and balances you'd expect from a Microsoft or a Google. They aren't fully there yet. It introduces a risk of restatements or errors.
For a conservative investor, that is a stop sign.
It could be. And then there's the cash situation. They are scaling, which means they are burning money.
Of course.
They're generating net losses from continuing operations. This is standard for high-growth tech, but in this economic climate where capital is expensive, cash burn is dangerous if they run out of runway before they hit profitability.
They crash. So how are they keeping the lights on? Are they just diluting shareholders to death?
They've been surprisingly disciplined there. They secured what's called non-dilutive working capital facilities from a group called Streeterville Capital.
Which means they're borrowing money against their assets or future revenue rather than printing new shares and watering down the stock price.
Correct. And they are using supply chain finance in India to manage the cash flow gaps. They're navigating that valley of death, that period between startup and profitability, very, very carefully, trying to avoid toxic debt.
So we have a high-risk, high-reward scenario. But is there any external validation? Is anyone else in the industry pointing to this and saying, yes, AI logistics is the real deal? Or are they just shouting into the void?
We actually got a major signal just this week. On February 16th, C.H. Robinson, the giant we mentioned, got an analyst upgrade.
And what was the reason?
The thesis was, and I'm quoting here, the AI scare is an overreaction. The analysts are starting to realize that AI isn't going to kill the logistics brokers. It's going to supercharge the ones who actually use it.
That's a rising tide that lifts all boats. If the market accepts that AI is the future of freight, then a pure-play AI company like Algorhythm becomes a prime acquisition target or a breakout star.
Exactly. It validates the entire business model. The sector is waking up.
So let's look forward. We have a volatile stock, a massive market drop, a validated thesis. What's on the catalyst calendar for the next 90 days? If I'm watching this stock, what dates am I circling?
The next 3 months are critical. We have earnings expected in March or April.
And what are we looking for in that report? Not just did they beat EPS, but what are the specific KPIs?
We need to see revenue acceleration in that India arm. Those pilots have to convert to full contracts. And in the U.S., we need proof of Apex adoption. We need to see them announce that a major 3PL has signed on.
We need receipts.
We need receipts. And beyond earnings, just watch the news flow. Management knows the stock price has been hammered. They're in damage control mode. So expect a PR blitz, conferences, interviews, press releases. They need to tell their story.
To stabilize the sentiment. So bringing this all together, you've analyzed the tech, the market psychology, the fundamentals. What's the verdict? How do you score Algorhythm Holdings right now?
I'm giving it a bullish score of 7.2 out of 10.
7.2. That's specific. Walk us through the logic of that number.
Well, it's a specific type of rating. It's not a safe haven rating. It's a swing trade rating. My thesis is that the market overreacted to the volatility earlier this week. That massive drop was a panic event, not a fundamental breakage of the business.
So you see a snapback.
I do. I think there is a potential for a relief rally of 30 to 50% leading into earnings. As the dust settles and that AI logistics narrative gets louder, that gap between the current price and its fair value should start to close.
30 to 50% is a massive move. But frankly, after a drop of billions, it's just reclaiming lost ground.
Exactly. It's a mean reversion play. But it is high risk. You have to be comfortable with the volatility.
It's not for the faint of heart. But the logic holds up. A company solves a trillion-dollar waste problem, pivots its entire business to do it, and gets punished by a market panic. That usually creates an opportunity.
For the brave, yes. That's the summary. And as always, we have to remind everyone listening, we're analyzing data based on search results from February 19, 2026. This is a fast-moving situation.
And this is not financial advice.
Absolutely not. Do your own due diligence.
Don't bet the farm based on a podcast. But this is definitely a story to watch. It's rare you see a company try to turn a karaoke machine into a logistics revolution. Whether they succeed or fail, it's going to be a fascinating show.
It certainly will be.
Thanks for breaking it down. This was a deep one. And everyone listening, keep your eyes on the road and your portfolio ready. We'll see you next time.